Hello, how are you doing today? This is Dan Petrell. We're going to turn it over to Adrian really quickly. I'm the Senior Director for Communications. I just wanted to let everybody know today's guest is Shawn Goldfaden. And if you read today's hot sheet, you'll see that I butchered his name, so we apologize for that. And we're very excited to having him on board. So we're very excited, and Adrian will introduce him. And one final note I just wanted to say is just to wish our event coordinator, Adrian Holaker, a happy birthday. It's her birthday today. So anyways, I'll turn it over to you, Adrian, and Shawn as well, and enjoy this webinar.
Thank you, Dan. Good afternoon and welcome to another installment in the Maryland Realtors webinar series. Today's webinar features Shawn Goldfaden, the Vice President of Business Development and Counsel at Land Services USA. He will be discussing 1031 like-kind exchanges. He is a solo practitioner and serves as a 1031 qualified intermediary. He's barred in Maryland and Georgia and is also a licensed real estate broker. He's a member of the National Association of Realtors, MAR, and GBBR. Shawn is a member of the Board of Directors for the Maryland Land Title Association, a past committee chair for the Maryland State Bar Association Commercial Real Estate Discussion Group, Urban Land Institute, and Young Lawyers Chair of the Maryland State Bar. He currently serves on the board of the Immaculate Conception Homeschool Association and is a guest lecturer for GBBR, Maryland Realtors, NPI, and has published numerous legal articles. As you have questions for Shawn, please place them in the Q&A box, and we will answer your questions throughout the presentation. Thank you again for your attendance. We will send links to the slide deck and the webinar in the following week. For now, it is my pleasure to introduce Shawn Goldfaden.
Thank you, Adrian. Thank you, Dan. I appreciate the introduction. I appreciate everyone's attention to this presentation today. We're going to talk a little bit about 1031 like-kind exchanges. And although I've been practicing law for over 20 years, I by no means know everything there is to know about 1031 exchanges. I've been a qualified intermediary for about 8 years, handling 1031 exchanges. I do not give tax advice because that would probably be malpractice. I got a B in tax in law school, and I got out because I knew there was no way that I was going to be a tax attorney. So most of my clients, when they come to me, I always advise that they have tax counsel or a CPA or a tax attorney involved in their transactions, as these can be very complicated. And just like you, I am a real estate broker. I have my broker's license. And we're going to walk through just the basics of 1031 exchanges. The first thing I have to do is tell you that Mid-Atlantic Exchange is a qualified intermediary. That's my company. Is defined under the regulations under the Internal Revenue Code. Neither Mid-Atlantic Exchange, its officers or employees are authorized or permitted under applicable laws to provide tax or legal advice to any client or prospective client of Mid-Atlantic Exchange. That's my disclaimer, and that's what I give to everyone generally. We tell them to reach out to tax or legal counsel in any transaction, whether it's a small 1031 exchange or it's a large 1031 exchange. I've done some as small as $50,000 and some as large as $30 million. So I know my way around. Like I told Dan and Adrian, I know enough to be dangerous. With that, I can tell you a little bit about Land Services. Not that I'm going to give you an infomercial, but I am also a commercial title attorney, and I work for Land Services USA as the Vice President of Business Development and Underwriting Counsel. We are the largest in the country. We write with all the major underwriters, as shown on the screen here. And we are licensed in probably 38 different states, 120 employees, and 20 some attorneys on staff. And I've been here for 4 years. I'm very happy. It's been an absolutely exciting opportunity for me and my staff. My office is located in Towson, Maryland. And anyone have any questions following the seminar, please feel free to call me at my office, and I will help you, try and navigate through the 1031 exchanges or any commercial or residential real estate transaction questions that you may have. So the goals for the presentation to supply you with a good resource for 1031 qualified intermediary services, impart a better understanding of 1031 exchanges, show you how to use your knowledge of 1031 exchanges to increase your sales and productivity, and make you a better sales agent and a resource for your clients. I can tell you that as a title attorney and a settlement attorney, we very often have situations where people come in and they are selling a business, they're selling a building, whether it's multifamily, whether it's retail, and it turns out that they are going to have some sort of tax implications because they're going to be walking away with a large chunk of change. So we always give them the opportunity, or I give them the opportunity to understand what a 1031 exchange is, even at the table. And I have been in situations where I've had to hurry and get my 1031 exchange documents done because the client didn't realize that they're going to be subject to capital gains. Capital gains is as many of you know, is a very sore source of subject because of the way that the capital gain structure is increasing and has been increasing over the years. Also, we're going to talk about the new potential for capital gains taxes increase or elimination with the new administration as we get to the end of the presentation. So what is the Internal Revenue Code Section 1031? Well, Section 1031 of the Internal Revenue Code allows a taxpayer who owns a property held for productive use in a trade or business or for investment to exchange a relinquished property, that's the one you sell, and defer paying federal, state, capital gain taxes and depreciation recapture taxes if they acquire a like-kind property to be held for investment or in a business. So, you know, it's not an exemption. You're not going to exempt your capital gains taxes. What you're going to do is, as I tell my clients, you're going to keep deferring them down the road until you fall into a lower tax bracket, or the property is inherited, or something else happens, like you buy into a partnership or a REIT or a TIC or something like that, where you have a less of an impact for the capital gains. The Internal Revenue Code Section 1031 has been in existence for over 100 years, and it has been through some changes, but not many. I can tell you that, you know, over the last 100 years, generally everything has stayed status quo with respect to 1031 exchanges and has become a very popular and recognizable vehicle to defer capital gains taxes. And at any given time, I have between 6 and 7 a month that I'm dealing with as a qualified intermediary. They are very popular now because there's a lot, as it is in the residential world, the commercial world, commercial industry is on fire. The rates are very low. There's a lot of money out there on the streets. The banks are lending, and there's not a lot of inventory. So I can tell you that a lot of qualified intermediaries are extremely busy because there's a lot of opportunity for people to make money selling their properties, and that's why the 1031 exchanges are becoming so popular in the last year or so. So why bother? Why bother doing a 1031 exchange? So when you hire a qualified intermediary, generally, like myself, we're going to charge you a fee for the handling of the exchange. It's the drafting of documents, it's coordinating the closing. We're going to go through that in a little bit. But you know, there is, on your client's behalf, some due diligence that they have to do. There's some work that they have to do on their end with respect to the exchange. You have to hire a professional, and you got to make sure you talk to your CPA. You've got to find a replacement property. You kind of got to know what the impact is of the exchange before you actually enter into a 1031, or else it may not make sense for you to actually do the 1031 exchange. So many investors are surprised to find out that they could face 4 different taxes. When combined together, the aggregate impact could result in a large tax bill. So the first tax is depreciation recapture. So when you own a commercial building or for use in a trade or business, you usually depreciate that property over a certain amount of years. You know, it could be 39 years, whatever it is, 25 years, depends on the property, depends on your tax bracket, et cetera. So depreciation recapture is taxed at 25%. So when you go to sell that property, you are going to have to pay back 25% of your depreciation if you don't do an exchange. Federal capital gains taxes. Federal capital gains taxes are assessed on the remaining economic gain, depending on the investor's taxable income. So investors in the highest tax bracket can pay somewhere between 25% and 15% capital gain tax rate applies to investors in a lower tax rate. So right now you're already at potentially 45% impact on your net on your net proceeds from the sale of your property. That means, I've had clients come to me and say, you mean that I'm going to be end up paying 45% of what I make on the sale of this property to the federal government and the state government? And I said, yes, it's going to be don't expect that you're going to get every penny back. Again, you got to talk to your advisor. You got to find out what your tax basis is, how long you've owned the property, that kind of thing. And it doesn't necessarily matter how much money you owe on it either. You could go out and take a mortgage out 2 years ago, and you could be netting out zero, and you're still going to have a cap gains tax impact. The third type of tax is your net investment income tax, and this gets a little bit complicated. So pursuant to the IRC section 1411, an additional 3.8 surtax applies to taxpayers' net investment income. And then there's a 3.8% Medicare surtax as well. So you've got those three taxes, and then you have your state and local taxes. So investors also have to pay the applicable state tax, which can be as high as 13.3% in California. In Maryland, the state tax rate, tax capital gains rate is 5.75%, which is top 6 nationally. So, for example, at the bottom there, an investor could end up paying close to 55% of whatever it is that they make on the net proceeds of the sale of their property to the feds, the state, local taxes, and capital gains in California, where they have the highest state capital gains tax rate. Are there questions?
Hey, Shawn, yeah, there are a few questions, and hello to all the members. Sorry about not being on right away. There was a technical difficulty with me being an attendee and not a panelist, but for those of you who don't know, I'm Drew Kelly. I am one of the attorneys here at Maryland Realtors. Shawn, one of the first questions someone asked is, do you have to acquire the new property before closing on the old property? And I'm sure you kind of get into the process in a bit.
That's correct. Yep. So we're going to talk about that in a little bit. Okay. The answer is no, unless you're doing a reverse exchange. And we'll talk about the difference between reverse exchanges, the standard exchange, and improvement exchanges later.
Okay. And did this used to be called the Starker exchange?
Yes, there was a case called the Starker case, which came out. I forget exactly when it happened, but there was a case that came out called the Starker case, and that's had to do with exchanges. It was somewhere in the mid 1900s or something like that, late 1900s. Okay.
Thank you. Yep.
All right. So, this is just a slide regarding the federal cap gains tax rates, and depending on your income tax brackets, that really depends on what the impact is going to be on your tax rates, et cetera. So not a very important slide. So the basic exchange. So I know it's a little blurry, but on the left-hand side, you can see where it says sale. That's the relinquished property. So that's the property that you're holding now. We call it the relinquished property. And you're going to relinquish that as part of the 1031 exchange. And when you sell it, the deed actually goes from the exchanger, not to the QI.
Hey, Shawn.
Yes.
We're not seeing the slide you're talking about.
Really?
So right now on our screen, it says, why bother? Higher tax rates.
What about now?
Still same slide.
Try unsharing your screen and trying to share again and see if that fixes it.
Okay.
Perfect. Basic exchange.
No, I'm not there.
Oh.
Let me see. All right, stop share. Now what do you say?
I see. Adrian, mine says Shawn Goldfaden has started screen sharing, but there's no.
So does mine. Let's give it a second and see if it's just loading.
In the meantime, will this also apply to residential?
No, I mean, it will if it's an investment property.
Yeah.
And we'll talk about that as well.
Okay.
You guys see my screen?
No, we don't see your screen. Zoom is great until it's not.
Bear with us, everyone, as we're figuring this out.
No.
Still no. Try stopping and sharing. Here, let me stop your sharing and then just give it one more go. See if we can get it done.
Sorry about
Thank
this.
you for your
everyone.
patience,
No,
everyone.
Not your fault. It could be.
As Drew says, technology is great until it isn't.
Yeah.
Let's see if I can toggle between my screen here.
Let's give it one more try, Shawn, and then
And if not, Adrian, if you have it.
yes. Let me pull that up really quickly. Yeah, it says you're sharing, it just gets stuck on the you're sharing it and we can't see the slide itself. Let me go ahead and pull up your slides and then I can share them. Okay, let me go ahead and share. Can everyone see this? Ooh, let's try again.
Shawn, can you define depreciation recapture?
Well, it's really just that. It's really just, so if anyone owns investment property, they talk with their advisor or their CPA about the depreciation that they deduct every year on their taxes with respect to the asset that they're holding. Usually depreciation is done separately for personal property and real property. Real property is usually depreciated over 39 years, let's say, where personal property is depreciated faster, like over 5 years, for instance. So every year when you file your taxes, if you own an investment property, whether it's real estate, whether it's a multifamily building, retail, whatever it is, that recapture, that the feds, when you go to sell your property, the feds are going to want that recaptured that you've deducted on your taxes over the years repaid.
Okay, thank you.
Uh-huh.
Okay, so Adrian, if you want to, yep, there we go.
Okay, so right there, let's stay with that one. And all right, so the basis exchange. All right, great. Thank you, Adrian. So you see on the left there, you got the sale, the relinquished property, and then the deed. So the basics of the 1031 exchange basically says that the deed is transferred from the exchanger, which is the seller, to the purchaser directly, and the QI does not get involved. That's for your standard exchange where you sell first and buy the replacement property second. At the bottom there, you see the exchange periods. So you have to identify property. We're going to talk about this in a little more detail in a minute. You have to identify the replacement property that you're going to buy within 45 days from the day that you sell your relinquished property. These are hard and fast rules. You can't mess around with these rules. So you actually have to give the qualified intermediary, which would be me, and I've got forms, etc. 45 days, you have to give them notice of whatever you're going to identify as your replacement property within 45 days. And it doesn't matter if you end up buying that property. There's just several different rules. There's a three-part property rule, which is the easiest, where you identify 3 properties. You buy one of them, you can buy 2 of them, or you can buy all 3 of them. It doesn't matter. And then there's a 95% rule and a 200% rule, which we're going to talk about in a minute. The total exchange period is 180 days. So you have to identify within 45, and then from day 0 or day 1 from the day that you sell your property to day 180, which is 6 months out, you have to close on that replacement property. All right, you want to move to the next slide? All right, so the basic terms. So the holding period, like we talked about, some legal advisors state that you have to hold the property that you are selling for at least 2 years. Now, the rule is that 1031 exchanges aren't used by builders or flippers because there's no intent to hold it for an investment property. If they call it more like inventory. So if a builder goes out, they buy a piece of land and they build a house on it, and then they go to sell it, it's not really being used for inventory. It's being used more for just to make a profit, basically. So the IRS generally has said in their private letter rulings, and this is what we go by in the world of qualified intermediary and 1031 exchanges, we look at private letter rulings, which is basically the tax court and the IRS saying, giving out, rendering memorandums and opinions with respect to certain scenarios. So generally the rule of thumb is that the property should be held for 2 more years. Some people think that's 1 year, 12 months, because it goes through a cycle of taxes, of 1 year's worth of taxes is enough. But I can tell you right now, it's basically the intent. The duration is very important, but the intent is more important. So like what I'm saying in a private letter ruling underneath the holding period, the IRS stated that 2 years would be sufficient period of time for a property to be considered held for investment. But these rulings don't constitute a binding precedent. So you can't look at them and say, just like case law, you can't look at them and say, this is case law or this is statute, so you have to follow it. The IRS does not have to follow any private letter ruling. Constructive receipt. So constructive receipt is important because generally if you have so let me give you an example. You have a business owner or an investor that owns a piece of property, and they go to closing on a Friday, and they don't know about the 1031 exchange. And after closing, or in the middle of a closing, someone mentions to them, hey, look, you're going to be getting, let's just say, for an example, $200,000 net proceeds out of this, and you're using this property as for business purposes or as investment. Have you ever thought about 1031 exchange? So the investor says, well, no, I don't really thought about that. I don't want to do it right now because I'm not really sure. I don't have enough information. I need to talk to my CPA. So let me think about it over the weekend. They want the title company to hold the money in the escrow account. So the investor goes and, over the weekend, and they talk to their CPA, and the CPA says, yeah, it might be a good idea for you to defer your capital gains. He comes back on Monday to the title company and says, hey, look, I want to do a 1031 exchange. Well, by that time, it's too late. You have to set up the exchange and sign the deferred exchange agreement with QI prior to closing, or at least at the closing table, because at that point the title company has the escrow funds that are earmarked for you, and they call that constructive receipt. Even though you don't, as the investor, have them, the title company is holding them on your behalf and for your benefit. So they can't really do anything with those funds without your knowledge or permission. So constructive receipt is anytime the money or property is credited to the taxpayer's account, set apart for a taxpayer, otherwise made available so the taxpayer may draw upon it at any time. That's an important definition. Drew, you have any questions that I need to address? Seems like the chat box is getting full.
Sorry. Yeah, so we do, I don't know if they fit in exactly where we are, but is it a 25% tax on the full depreciated amount or a taxable rate on 25% of the full depreciated amount?
So you'll have to talk to your CPA about that because it depends on the circumstances.
Okay, and then what's the difference between like-kind exchange and simultaneous exchange?
There's no difference. Simultaneous, you can have a simultaneous exchange with which is considered a type of a like-kind exchange, where you buy and sell on the same date. It's very rare that you're going to have parcel, property 123 Main Street that is going to be exactly like 456, West Street or whatever it is, where you're going to exchange a property for a property. That is an exchange, but it's very rare that it's going to be dollar for dollar, the exact amount, and the exact assessments, that kind of thing. You could do that kind of exchange where you exchange black acre for white acre, and there's no real money that's transferring, but that never happens. I can tell you that in all the years that I've done this, I've never had a property exchange for a property, and it's 0-0 net.
Someone just said, I thought there was a specific time before closing to do 1031. Are you sure it can be done at the closing table?
So generally, you're supposed to enter into a deferred exchange agreement with the qualified intermediary before closing, and that generally occurs after the contract is executed or at the same time that the contract is executed. That's the preferential period of time.
But it could be done.
It could be done before anything. Yeah, it could. Generally, you have to engage the QI beforehand. That's generally the rule.
Okay. Can you buy into a pool of properties or a company that holds properties?
Yeah. So I think we need to skip over these questions because we're going to answer those as we go along.
Okay.
So
great.
why don't we just move along, and I will try and answer whatever's left over,
Okay.
residuary questions. Okay, so the identification period, we talked about that has to be 45 days. The exchange period, again, it has to be completed by the earlier of 180 days from the transfer of the relinquished property or the due date from your tax return for the year in which the relinquished property was transferred. So let's say, for example, your relinquished property closes after October 17th of 2021, and you file your taxes just like everyone else on April 15th. So you have to complete your exchange by April 15th, or you have to file for an extension for your 2021 taxes. So that means that if you sell your investment property, let's just say on November 30th, you will have to have an exchange deadline. You will have an exchange deadline of April 15th, which is really only 136 days. So in order for you to get the full benefit of the 180-day exchange period, you have to file for an extension. Some vesting questions or some vesting reflections. Generally, if a wife relinquishes a property, then the wife should acquire the property. There is a private letter ruling that talks about husband and wife as owning it, regardless of whether it's joint tenancy or tenancy in common. If the wife owns it, the wife and the husband generally cannot buy into the replacement property. Now, there's ways to structure it so that we could add the husband later, that type of thing. But definitely, generally, it's one person owns it, one person buys it. If an LLC relinquishes the property, then the same LLC should acquire the property. If a corporation relinquishes, then the same corporation acquires. Now, there are exceptions for SPEs, special purpose entities. There's also an exception for individuals who sell a property in their individual name, then they buy it in a sole member LLC. For the IRS considers those disregarded entities, and what it basically means is the individual is the alter ego of the LLC and vice versa. Because
we're getting a lot of questions about multiple members of an LLC.
So generally it should be a sole member LLC. If there are multiple members, those members you have to draft the operating agreement very specifically, and those members really should only be there to prevent the LLC from entering into bankruptcy. It gets very complicated. I can talk about it offline, but most of the time I have had, whether you can have TICs, okay, tenant in common interests. We're going to talk about REITs, things of that nature as we move along in the slides. So let's go to the next slide. All right, so what is a qualified intermediary? A qualified intermediary is also an accommodator or a facilitator under the Internal Revenue Code. So a qualified intermediary is a person who's not the taxpayer or a disqualified person. So generally, it can't be your lawyer, It can't be your title company. It can't be your nephew, can't be your uncle. It can't be your agent. It has to be, it's totally separate, disinterested third party from the transaction. A lot of title, you'll see that a lot of title companies own qualified intermediaries, and really it's just a driver to get the title business. That's generally why they do it. But the entity, the qualified intermediary entity, is just a standalone entity on its own. Generally, you enter into a written agreement with the taxpayer. That's the exchange agreement that we talked about earlier. And so the qualified intermediary acquires the relinquished property from the taxpayer, transfers the relinquished property to the buyer, acquires the replacement property from the seller, and transfers the replacement property to the seller. We'll talk about that in more detail in a little bit. And then the exchange agreement must expressly limit the taxpayer's rights to receive, pledge, borrow, or otherwise attain benefits, etc. So most of your standard exchange agreements will have that language in there. Let's go to the next slide, please. So next slide. So QI coordinates with the taxpayer's attorney and their tax advisor. They prepare this exchange documents, which include the exchange agreement, the assignment agreements, notice of assignment, and they give instructions to the closing attorney or the title company. The QI also oversees the closing to assist the exchange procedures. The QI facilitates the sale of the relinquished property to the buyer, and holds and protects the exchange proceeds on behalf of the taxpayer. So the title company would send me how it's structured. The title company would send the entity, the QI, the funds to hold in a segregated escrow. You want to make sure that whatever QI that you use, they're holding it in a segregated escrow account on your behalf, and it's not commingled with all the other 1031 exchange proceeds. The number 8, the QI provides some guidance, but not necessarily tax advice. Again, that we reserve that for your CPA or your tax attorney. All right, let's go to the next slide. We're about vesting. So we're talking about partnerships and LLCs. So a sole proprietorship can hold the relinquished property as an individual, but acquire the replacement property as a single member, single asset LLC. Again, I talked to you about a disregarded entity. That's what this means. For federal tax purposes, they are considered alter ego themselves. It provides the benefit of liability protection. Again, if you're going to create an LLC, which I tell all my clients, because I have my own law firm as well, you want to create an LLC to protect you from any type of liability. Now, everyone has insurance on their properties, but if someone slips and falls, they can sue you for over and above your insurance protection, et cetera. The LLC will protect you from individual liability, where they would sue the LLC. And generally not sue you unless there was some sort of failure to create the LLC or something like that. There was a hand that was raised, I think, Drew.
I saw that. I don't know if they are able to talk. So if anyone has a question, please just type it into the Q&A chat, and we will, we'll cover it as we go.
So one question, it says, what would happen if you don't own the property for 2 years? So if you don't own the property for 2 years, either prior to the exchange or after the exchange, when you actually buy the replacement property, the IRS could come in and say that you weren't really using, and sometimes this happens with vacation properties. I've had situations where people, because of the way that the market is, they swore up and down that they bought this property for investment, that they were going to use it for the requisite period of time for themselves. And we'll talk about that in a minute. But the market is so hot, somebody came and made them an offer a year after they bought it. And, basically they were going to double their profit. So they sold it. And I told them, look, I said, I can't give you advice except for the fact that, if you sell it under that 2-year period, you could be okay if you show all of these criteria. If you show all these things that prove your intent, that you're going to use it for a business or you're going to use it for investment. And we'll walk through those with respect to vacation homes as we get further down on the slides. So grantor trusts, a taxpayer can acquire replacement property in a revocable living trust, or the grantor trust for estate planning purposes. That's fine as well. If there's a death of an exchanger, if the taxpayer dies during the exchange, I've never had that happen, but I've heard horror stories about that. The taxpayers, the state can complete the exchange on behalf of them because they're also considered an alter ego. For partnerships, you can stay on that page. But for partnerships, it gets a little more complicated. So, for instance, if you have a partner as part of a partnership, and they don't want to do the exchange, and you want to sell the property, and you have a general partnership or a limited partnership, whatever it is, there's a couple of ways that you can structure it, and they're called the drop and swap or the swap and drop. So essentially, a partnership interest is not in itself a like-kind exchange, not eligible for a like-kind exchange. The whole partnership as a whole, the entire partnership, the owner, all of those partners can join in to exchange for replacement property. But generally what happens is, and what I've seen happen is, one of the partners says, look, I want my money now. We're selling the property. We've owned it for 30 years, whatever it is. I want to get out. And the only way that you can do that without upsetting the exchange is to do a drop and swap. So you'd have to drop one of the partners out, pay off their interest in cash. And that would also be subject to the 1 year, 2 year holding period as well. So you want to do that way in advance of selling the property, which very rarely is done because these things come up usually at the last minute. The other way is a swap and drop, where you actually close with the partnership, you buy with the partnership, and after a year or two of holding the property, then that partner can drop out. So that's the swap and drop. You swap properties and then you drop the partner out. Again, these get very complicated. You got to talk to your tax advisor, you got to talk to your QI, talk to your attorneys, and talk to the partners themselves about what they want to do if they are engaging in an exchange. All right, so can you go to the next slide, please? So this is a good exchange equation, which kind of gives you an idea of dollars and cents when it comes to the exchange. So you have for this example, you've got the relinquished property on your left side. That's the property that you're going to sell. And you've got the replacement property on the right-hand side, and that's the property you're going to buy. So let's just say the relinquished property value, let's say the fair market value is $450. That's the contract sales price. Now you currently have debt on that. All right, and we're not going to talk about big cost basis and all this other stuff. We're just going to assume the very basics here. Let's say you've got a mortgage on the property. Your debt service is $250 on the property. So your net equity on that is going to be $200,000. So $450 minus $250 is $200,000, and that's what you would pay your cap gains on. So you want to buy a replacement property. Now the first rule of thumb is you either have to buy equal to or in excess of the value of your relinquished property. So in this instance, you can't buy a replacement property for anything under $450,000. Otherwise, it's going to be considered not eligible for a 1031 exchange. You have to go equal to or above. And people get hung up on that all the time. So the replacement property in this example was, so you're buying up. And this is a really good example because this is the way that the 1031s were supposed to help the economy and increase taxes and help build wealth and help build jobs and things of that nature, which we're going to talk about in a little bit. So the new property that you are going to buy into is $600,000. The debt that you're going to put on has to be equal to the same debt, or it has to be greater than the debt. So in this case, you've got $400,000 mortgage that you're going to put on, so it's greater than the debt that you released on the relinquished property. So your net equity stays the same. So the taxpayer's acquiring property of greater value, reinvesting all of their net equity. The $200,000 would basically be what I, as the QI, would be holding, and increasing the mortgage on the replacement property. So therefore, there's no boot and no recognized gain. A boot is basically what you would have to pay. That would be the difference between whatever the gain is on the sale of the property, whether it's mortgage boot, whether it's equity boot, whether it's proceeds, whatever it is. That's what you would pay on the cap gain. So in this case, there's no recognized gain, and the 1031 exchange works out perfectly. Let's go to the next slide. All right, so this is example number 2, where the taxpayer actually is keeping $50,000 of the exchange proceeds. So you can do a full exchange or you do a partial exchange. I've had people that said, look, I need to go buy a boat. I'm only gonna do a partial exchange. So I'm gonna take $50,000 out of my proceeds. And I'm only gonna use the 150 in this case. So you get the same scenario, you get the same debt, and you get the same net equity, but you withheld the $50,000 at the sale to go buy a boat or whatever it is. So because you're only reinvesting the 150, you actually have a taxable gain of cash boot of $50,000, which you'd have to pay cap gains on. Let's go to slide 3. Okay, so in this case, you actually go down in debt. You've reinvested all your net equity to $200,000. The value has gone down because your replacement property has gone down, and your debt has gone down. And so in this case, you acquire property of a lower value. Even though you reinvested all $200,000 of the money that's being held by the QI, you're still acquiring a property with less debt. So the taxpayer has reduced debt by $100,000 in mortgage boot, which results in a gain of $100,000. So therefore, that's going to be subject to the capital gains taxes. I'm going to go to the next slide, please. All right, so we're going to skip through this scenario. I think everyone probably got the idea with respect to mortgage boot, et cetera.
Shawn, what is the best and easiest vesting someone should use?
Sole LLCs. They're the easiest because they're considered pass-through, and you're doing a Schedule C instead of a Schedule K on your tax returns, and they're disregarded entities. But talk to your attorneys, talk to your tax advisor, and find out what you currently have. If you want to create a new LLC, just for the purposes of doing the exchange.
And then for the purposes of doing the exchange, could it then be dissolved and placed in individual names?
After you buy the property?
Right.
I mean, essentially it could be, yes. But you would have to show that you were using it for that LLC with the requisite period of time.
Okay.
I mean, again, it gets complicated. It's a case-by-case basis, honestly. Right. And I wouldn't recommend it, because then at that point you're losing your insulation from liability. Right. And because, if you take it out of the LLC, then someone could come in and say, well, that's an ultra vires act. For us lawyers, we know what that means. It basically means you're doing something outside the scope of what you created the LLC for, right? And therefore, you as the individual, we call piercing the corporate veil. You as the individual could be sued as part of the acts of the LLC. So we never want to do that. We want to keep it as part of, for continuity purposes, we want to keep it as part of the LLC as long as you possibly can. Now you can bring in, doesn't mean you can't bring in members later if you want to. But again, for IRS's purposes, when you do if they do their audit or something like that, you want to be very careful.
Thanks.
So sure. So like kind of property. So the good news is that nearly any type of investment property qualifies for a 1031 exchange. You can't use your primary residence. Okay. Now there are some very narrow, I guess, exemptions for primary residence for using part of the house for business purposes, like you have a home office, especially in this day and age where the pandemic has made everyone work from home, that kind of thing. Then you have to do some sort of allocation. You got to really talk to your tax advisor about that if you're writing anything off. But generally, for the most part, your primary residence doesn't qualify for a 1031 exchange. You still have the 250 and the 500 for a couple, 250 individually and 500,000 for a couple exemption. Most people, unless they're super rich, don't go over that $250,000 or $500,000 net proceeds on their primary residence. So it hasn't really been that big of an issue lately. The location of the property doesn't matter either. It just needs to be in the United States. So for instance, here's a couple of examples: unimproved property for improved property. So you can do vacant land for office building. You can do a fee simple ownership for a leasehold with 30 or more years. Leaseholds are very popular. Target does a lot of these leasehold properties. What just closed the other day on a leasehold property? There was a Sheetz. So if you bought let's see if Sheetz, they're corporate owned, but let's just say for an example, if you had a Sheetz or another type of gas station or convenience store, something like that, A lot of times they have leasehold policies or leasehold interests in the land where the landlord owns the dirt. Sheets goes in there, they build the gas station, whatever convenience store, whatever it is, and then they rent it out for 30 more years. So you could do a fee for a leasehold. Like I said, vacant land for a commercial building, a duplex for a retail property, anything really applies. Farmland for conservation easements, those are very popular these days because there's a lot of conservation easements out there, especially in Maryland. Let's go and skip to the next slide. All right, so this was a case that came before the tax court when you're talking about vacation home exchanges. So, like I said, vacation homes are permissible to exchange into or out of. In this case, the taxpayers who were hit with their capital gains tax argued that the properties were being used for investment. That was both the relinquished property and also the replacement property. They exchanged a lakefront property with a mobile home, mobile manufactured home. Just for our purposes of discussion, we'll assume that it's not really a mobile home, that it's actually a manufactured home. It's sitting on a base or something like that, and is actually attached to the property. So the court said because of the taxpayer's significant personal use of the property, both the relinquished property and the replacement property should be viewed as held primarily for their personal use and enjoyment. And the court considers generally the following, and we're at 1, 2, 3, 4, 5, the fifth point: the taxpayers never rented or attempted to rent the property. So in the situation that I had where the woman owned the property down in Ocean City, she showed that she was out actually actively trying to rent the property, that she was trying to rent it for fair market value, that she wasn't trying to gouge people, or wasn't trying to rent it over fair market value or something like that to dissuade people from renting it so she could use it for herself. The other factor was the taxpayers deducted mortgage interest as a home mortgage interest expense. Well, you can't do that on an investment property. So the court said, look, that's another strike against you. Taxpayers did not take and probably didn't call for depreciation or other tax benefits associated with investment property under the IRC, including deductions for maintenance and expenses, another strike against you. So the bottom line is the mere hope or expectation of the properties being sold at a gain cannot establish investment intent if the taxpayer uses the property as a residence. Go ahead and skip to the next slide. So generally what you want to tell your clients that if they're going to buy a vacation home, and they're going to use a 1031 exchange, you want to use it for at least 24 months immediately prior to and after the exchange. Within each of the 2 12 months period, want to rent the property to another person or persons at fair market value for 14 or more days. Okay, and that doesn't mean your cousin or family member or something like that. You want to make sure that you show that there's a real lease agreement, third-party arm's length type of sale or rental, and that the taxpayer's personal use of the dwelling can't exceed the greater of 14 days or 10% of the number of days during the 12-month period that the unit's rented at fair market value. So just for your purposes, I know I went through that very fast. Rental properties are eligible for 1031 exchanges. Okay, so our capital gains, we're running out of time here. Generally, how are they calculated? So we can use in stock and investment, as an example. So basically, let's say that you held stock for a $10,000, you sold stock for $10,000 profit this year, and then you sold another stock at a $4,000 loss. You'd be taxed on the cap gains of $6,000. It's really the way the net cap gains is. That's kind of like how they're calculated. Go to the next slide. We already talked about boot, cash boot, mortgage boot. You got to be careful. So what doesn't qualify for a 1031 exchange? So generally stock and trade, stocks, bonds, and notes. Other securities, interests in partnerships, certificates of trust, choses and actions. I mean, if you sued somebody and you have the ability to collect on a judgment, that's not that's not eligible for 1031 exchange. And then personal property, which changes with the 2018 change in the tax code. The Trump administration, when they changed the code, they eliminated personal property. We used to do 1031 exchanges for racehorses, airplanes, artwork, that kind of thing, but those are no longer eligible. Go to the next slide. All right, so the delayed standard exchange identification rule. So we've got so again, within the 45 days, you've got to identify your replacement property. What I tell my clients is it's most important that if you know you're going to do a 1031 exchange, you're going to sell your property, start looking for that replacement property now. Like I told you, even if it's commercial or investment, the market is super hot. There's low inventory. You're going to pay increase. The cap rates are out of control because the people, the commercial investors, they think that they're going to save money on the interest rates, and they're going to make it up, or I'm sorry, they're going to pay extra on the cap rates, but they're going to make it up on the low interest rates right now because you're seeing interest rates for commercial properties, tens of millions of dollars, in the 4s and 5s, that kind of thing. So it's a very, very it's a very hot market right now. So anyway, you want to start looking for your replacement property right away. So there's 3 rules that you have to do when you're identifying your replacement property. There's a 3 property rule, which is the absolute easiest. So you can identify up to 3 properties without regard to the fair market value of any of them, and you can close on 1, 2, or all 3 of them. The 200% rule basically says that you have to identify any number of properties so long as the aggregate fair market value doesn't exceed 200% of the fair market value. But like I said, you want to start looking and doing your due diligence. You can go under contract on a replacement property without having sold your relinquished property yet. That's fine, as long as you don't close, unless you're doing a reverse exchange, which are very complicated. We'll talk about those in a minute. Or the 95% rule, which we can say you can identify any number of properties without regard to the combined fair market value, so long as the properties that you acquire amount to at least 95% of the fair market value of all of the identified properties. That is a very difficult rule. I rarely ever see that because it's so difficult to comply with. All right, next slide. So the improvement exchange, these have become kind of popular because, I'll give you an example. So we had a situation where there was a gentleman that was selling an old Kmart and didn't want to sell it because he didn't want to pay the capital gains. And he was holding on to it. There was a lot of deferred maintenance on it. It was dilapidated. The old rule is that sellers hold properties and buyers renovate properties. And that's pretty true in any circumstance because you want bigger rents, right? You want bigger tenants, you want larger franchises, and that kind of thing. So when you go to buy, all my investors or commercial clients, when they go to buy, they're always looking to renovate. So anyway, the Kmart owner was approached by a Costco owner, and the Costco owner said, look, why don't you enter into a 1031 exchange and defer it, and then you can go buy another building. But in the meantime, this is a great location. It's perfect for us. And it's just sitting here, and it's stigmatized, and it's bringing down the value. There's no real reason for you to be holding on to this property. So what they did was they did an improvement exchange where it was basically like a reverse exchange, but they take the money and they do the improvements on the property, or they can build a new replacement property. That's one type of exchange. Go to the next slide. So the reverse exchange is a little more complicated. I personally don't handle them because they're very complicated. So you have to set up a separate LLC, which is called an exchange accommodation title holder. We call it an E. So when you would actually go and sell because the market is so hot, you actually would, and you find a property that you absolutely love, it's perfect for you. It may be too good to turn down, so you have to buy it. So you go in and you buy it and you set up this exchange accommodation title holder. QI does all this work. I can tell you right now, they're very expensive. I've seen some qualified intermediaries charge anywhere between $20,000 and $25,000 just for the exchange process. Okay, I don't do them. I have people that I know that are very good that can do them. I can refer them to you. But if you have a situation where it's a hot piece of property, you love it, you will definitely want to buy it, but you haven't sold your relinquished property yet, you have the option to do a reverse exchange. Let's go to the next slide. All right, we'll skip through this. This is basically just on transfer taxes and recordation taxes with respect to 1031 exchanges, where the Attorney General has said that you're not going to get charged twice for transfer and recordation taxes when you have an EAT involved, or what they call a straw man, where the qualified intermediary is involved. So again, anyone have any questions about that, they can talk to me about that offline. The next slide, tenant in common basics. Okay, so this is fractional share. or you can buy into a TIC or a Delaware statutory trust. These are good if you're running out of options, and you can find a TIC that you like, or a Delaware statutory trust ownership that you like. So the problem is that you have to make sure at the very bottom there where it says caution, you got to make sure that it can't be considered a joint venture or a partnership. Like I said, partnership interests are excluded from tax deferral treatment under the 1031 exchange. So the TIC or the DST also doesn't provide for a lot of control for you as the owner. Whereas if you went and bought a replacement property on your own, you control it as the landlord, what as the owner, whatever it is. The TIC actually has a sponsor that sells you the fractional interest. And they're the ones that are responsible for the maintenance, the leases, all that kind of stuff. So there's cost benefits, that kind of thing. All right, and then this is the trade-off. Next slide.
Shawn,
Yeah.
Does the closing time in these exchanges, does doing a 1031 like-kind exchange add a lot of time to the closing period?
No, generally not. Because what you're going to do is you'll know in advance that it's going to be a 1031 exchange. I'm going to show you the addendum that is generally used by your sellers. So the QI's involvement should really be very transparent and should be very easy to work with. QI should not be holding up anything with respect to the 1031 exchange. So it doesn't really necessarily affect the time frame as far as closing, because there's no real due diligence with the QI. Now reverses are a little bit different, because if you're gonna do a reverse exchange, you got to have time to set up the LLC, you got to have time to create the EAT, you got to have time to transfer the funds, the deed actually goes to the EAT, and then you have to set up the financing. So in a reverse exchange, the financing is actually done not by you as the exchanger, but the bank that you're using has to agree to use this EAT, and you are now a guarantor for the exchange accommodation holder. And you have no idea, who's going to pay the mortgage, but it's got to be done pretty quickly. So, but generally the answer is no.
Thanks.
So keep going. Next slide. Keep going. Next slide. Next slide. Next slide. All right, so some costs can be deducted as part of exchange expenses. So transactional costs that are referred to exchange expenses on the IRS form 8824 are not specifically listed, but generally include costs that are direct as a result of selling the property. So you can deduct from your cap gains proceeds or your proceeds that are subject to capital gains, real estate commissions, title insurance premiums, closing costs, legal fees, transfer taxes, all the things that are set up. You can't generally deduct pro-ratable types of adjustments. That would be water or utilities or security deposits or rent or things like that. Those aren't considered closing costs that are deductible. So we usually tell them to be taken off of the settlement sheet and shown as an addendum or paid for by the exchanger separately in a separate wire to the title company, so that they can reimburse the seller for, or the seller reimbursing the buyer for whatever that proratable amount is. Go to the next slide. So earnest money deposit. So if let's say you do the exchange with me, and I'm holding the funds in your segregated account. And you say, Shawn, I bought another property, or I'm under contract for another property, and I need a $50,000 deposit. So you can do one of two things. One, you can either take the money out of your pocket, $50,000 out of your own pocket, and get reimbursed at the closing table when you go to buy, and that won't be subject to capital gain. Or I can take it out of your QI funds and wire it to the title company, whoever the escrow agent is, whatever it is. And then that way you don't have to come out of pocket. So there's a couple of ways that you can handle the earnest money deposit. Next slide. All right, so just real quickly, the Tax and Cuts and Jobs Act, I told you earlier that eliminated any capital gains exemptions for sales or deferments for sales of personal property like machinery, equipment, the artwork, planes, horses, things of that nature. It also had a deduction for interest on HELOC loans. So when you take out a home equity line, let's say you take out a home equity line to pay for your kid's college, well, you can no longer deduct that on your taxes. Now, if you take out a home equity line and you use that for improvements on your property, you can use that still as a deduction, but you have to prove to the IRS, look, I rebuilt a deck, or I renovated my house in some form or fashion, that kind of thing. Next slide. So whenever you enter into a contract to say, oh, I have an addendum that I use, but the Maryland Association of Realtors also has an addendum for 1031 exchanges. And generally for the relinquished property, all we do is just say, look, the buyer and the seller understand that there's going to be a 1031 exchange involved. There's going to be a qualified intermediary. Everyone's going to hold the QI harmless. They agree to cooperate with the QI and with the other parties with respect to the exchange. But we're also going to hold the buyer in this situation where the seller's the exchange. You're going to hold them harmless from anything that happens because of the exchange. Have we run out of time completely?
So there's not a real hard cutoff, but if you see a good cutoff time.
Okay.
Also, these slides are going to go out. So, you know, a lot of people wanted you to go back to the REITs. Those slides will be there.
Yeah,
Does the
REITs
IRS, sorry.
Yeah, REITs are tricky, but they can be eligible for like a TIC or a DST, but they are tricky. So you really need to have counsel involved to help you navigate through if you're going to buy into a REIT. And it's generally you want to buy a REIT, you want to buy a property that is going to that is eventually going to be rolled into the REIT, for instance. So it's not the REIT itself, but it's the property that you buy that rolls into the REIT. There's a contribution for the REIT, for your involvement in the REIT. But so you're not, in some instances, you're not really buying into the REIT itself. I'm sorry, Drew, was there another question?
Yeah, we have a couple questions, but most recently, does the IRS actually monitor how long you rent the replacement property? I'm sure the answer is yes.
I'm sorry, what was the question?
Does the IRS actually monitor how long you rent the replacement property?
They will in an audit.
Yeah.
Yeah, I mean, it's all going to be subject to the audit, whatever it is. And you have to fill out the 8824 form with your CPA when you file your taxes. And you're going to have to show the rental income that you made, that kind of thing. So these are all indicia of intent, like we talked about earlier. What was your intent on using the property? You're not going to use it for a vacation home and go there every weekend, which could, I mean, as long as you're not using it for more than those 14 days or 10% of what a total rental time is, that kind of thing. So you want to, those are kind of hard and fast. Those are hard and fast rules.
Well, and I want to say, just as an attorney, and I know you are too, we, you know, all our members, some are attorneys, but most are not. And so everyone, you want to be really careful not to practice the unauthorized practice of law. This is a really complicated topic, and it keeps Shawn employed. So, you know,
Yes.
The point is you got to hire an attorney. You got to send your clients to a well-recommended attorney. These are complicated issues. And that's why, you know, Shawn, we're so grateful that you're here to discuss them.
Yep, thank you. So can you skip to the next slide? So that's the relinquished property. This is the replacement property language. Again, I have addendums. If you need one, you think your seller is going to enter into a 1031 exchange. Next slide, please. All right, so this is the MAR addendum for 1031 tax deferred exchange. Basically the same language that I have on my addendum. So this is available for anyone who's a member. All right, we're not going to talk about this. Let's want to get to the juicy part. Cost segregations are good for if you have a client that's selling, let's just say, a building that has a lot, like a hotel, where they got a lot of FF&E. That would be furniture, fixtures, and equipment. Or if they are, we do a lot of cost segregations with automobile dealerships where they've got a lot of inventory. You need to get a cost segregation study from one of these giant accounting firms if you're going to sell like a property like that. And the IRS looks at those cost segregation studies, and the benefit of this, it's amazing because the benefit of this is you can actually segregate the personal property from the real property for depreciation purposes. So like I say there in the third sentence or the third line, it says, you can actually depreciate a part of the components of the commercial building as personal property on a 5, 7, or 15-year depreciation as opposed to a 39 or 27-year depreciation. So because you do that, you make money at the end because you depreciate it that much faster. That's more money in your pocket at the end of each year. And you can use that to reinvest into the property, pay payroll, whatever it is. So these cost seg studies are amazing. They work well. It's a marriage made in heaven between the 1031 exchange and the cost seg studies. So just keep that in the back of your mind if you have a client that that owns a property that has a lot of personal property attached to it. All right, we're going to keep skipping. Skip. All right, so one horror story way back when the market crashed, whatever it was. So if anyone ever saw The Big Short, it was a great movie. Christian Bale was the only guy that really realized what was going on, which is shocking. But Latin America 1031 Exchange Services had a qualified intermediary, and they were taking all the money and all of the QI money, and they were reinvesting it, unbeknownst to a lot of their customers, into asset-backed securities. Okay, and these asset-backed securities were secured by real estate, of course. Right. So when the real estate market tanked back in 2007, there was all of these funds became insolvent. So all this money was lost. The QI exchange funds were lost. So they had to file a bankruptcy, and all the taxpayers lost their money as part of the exchanges, et cetera, et cetera. So just gotta be careful about who your QI is, who you're dealing with. Make sure that they've got a good banking relationship about where they're going to store your money. It's a segregated account, and get, every once in a while, just call up the QI and say, hey, look, do you have my balance? Just show me my balance on the paper. So, or give me a screenshot of my bank statement or something like that. All right, so let's get to the sexy part of this. The next slide. So 6 strategies for increased commission. So those people that want to do, my commercial presentations have been overwhelmingly popular because people, obviously, commercial properties, bigger values, bigger commissions, right? So obviously, 1031 exchanges are great for people that want to get into the commercial business. So the first thing is you have 2 transactions. So one, you have a seller that you represent who wants to do a 1031 exchange. Well, they're also going to be a buyer, and they could buy one or multiple properties. So you're going to earn commissions on the sale, and then you're also going to earn commissions when they're the buyer. So that's two transactions, 2 or more transactions. 2 or more replacement properties. Many taxpayers leverage their real estate investments and purchase several replacement properties. They don't have to just buy one, they can buy multiple in different markets, that kind of thing. So you're looking for taxpayers with high equity positions in relinquished properties. They can get a better rate of return on several properties with little or no debt, as opposed to one big property with a lot of debt. The seller of the taxpayer's replacement property also may hold a property they're selling for a 1031 exchange. So you may be able to get them as a client as well. So when the replacement property is purchased, that seller may say, hey, you can, unless you don't want to talk to them because it's verboten, because they already have a relationship with an agent or a QI, you can say, hey, have you ever thought about a 1031 exchange? I happen to be a 1031 exchange expert. Again, without giving any legal advice or anything like that, I deal with a great QI. His name is Shawn. He can walk you through it. And maybe you can get commissions on that deal as well. Larger properties equals larger commissions. That's an obvious. Drew, the next slide, or Adrian, the next slide. Become an exchange agent. Okay, so you learn more about exchanges. Real estate professionals can differentiate themselves from other competitors in the market. People that really understand 1031 exchanges can develop a base of repeat clients. And these are usually high net worth clients. And it can lead to an established clientele, less time working to farm an area to produce business as a base of repeat clients, et cetera. And there's a proactive tool to find new investor customers. You can use the 1031 exchange to market yourself as a professional. Okay. So it's funny. Go to the next slide, please. So it's funny because every once in a while you'll see emails that come over from like 10X or some of these big auction houses that say, this is a perfect 1031 exchange property, blah, 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 blah. So it's hard to determine what the characteristics of an attractive 1031 placement property is, because property is property and commercial property is commercial property, whether it's warehouse, whether it's, industrial is off the chart right now. So everybody that owns industrial properties, should be selling as quickly as possible, because that's the hottest market, where hotels are not very hot right now. I just saw one that went to foreclosure down in the city yesterday. But hotels have their cycles. So, I think in 3 to 5 years, hotels are going to be hot again once everybody comes out of the pandemic. But regardless, that's my opinion. So what are the characteristics of an attractive 1031 exchange? So you got a lower shortened due diligence period, prior inspections, prior title clearance. So if you have a property that's already been under contract, it's already had their inspections, it's already got your title clearance, that kind of thing. We like to produce title commitments well in advance for auctions and things of that nature, so that the people can have a clean policy. They can say, okay, I know what I'm getting into, and I can make my offer that much more attractive, because I can say, okay, instead of a 45-day due diligence, I'm going to give you a 25-day due diligence, because it's cash. It's going to be either cash from the 1031 exchange, or it's going to be financing that I've already got my financing lined up, and I'm ready to roll. What else makes an attractive property? Well, you purchase the replacement property, which is of different type. And I'm sorry, my my second note there ran off. But so, for example, a lot of people are going outside of their comfort zone, where multifamily developers that are now buying office properties. So their replacement property can be more attractive, and depends on location as well. Cash is king. So a discounted property that's otherwise stigmatized, et cetera, may sell for a lower cap rate, or, they may be more inclined, the seller may be more inclined to sell it to you if you have cash from a 1031 exchange, right? And you can discount that by saying, look, I don't have to worry about financing, okay? I don't care if your property is stigmatized. I don't care if there's a lot of deferred maintenance. I'm going to rebuild anyway. I'm going to renovate anyway. So that makes it more attractive. Net lease properties, generally where the tenant is responsible for the maintenance, the upkeep, the payment of the mortgage. That's stuff that's taken off of the plate of the landlord. So it's a lot easier to sell those properties because the landlord isn't responsible for all of those, that overhead, et cetera. And then many of these leases are guaranteed by a national chain, which is beautiful. If you can get like a national chain that is well heeled, not like a JCPenney, but maybe something, like another national chain, like a Wegmans or something like that. Obviously, that makes for a very, very attractive replacement property. Go to the next slide. Yeah, we don't need to talk about that. Go to the next slide. So like I said before, you want to make an offer on a replacement property before closing on a relinquished property, because that 45 days goes by fast. It's only a month and a half. You've got to identify. You want to know what you're getting into, because I've had at least 3 or 4 in the last 4 months that have failed because they've been unable to identify or close on that identified property. Now, I will tell you, the one caveat is, if you do identify within that 45-day period and you cannot close, on day 60, you cannot ask for the money back. Generally, I have to hold it, or else the IRS will consider that a failed exchange and not really an exchange. You never had the intent. You just wanted somebody to hold it as an insurance policy. Generally, that's what they call it. It is an insurance policy, because you don't know whether you're going to find a great property that you want to exchange into. So you want to get that offer out on a replacement property, or you want to have a LOI out on a replacement property, letter of intent on a replacement property. Start your due diligence, start collecting information, that kind of thing. Start getting your financing lined up. And although the start of the identification period is triggered by the relinquished property sale, doesn't prohibit you from entering into a contract, like I said before. The COVID rules don't apply. Go to the next slide. So the COVID rules don't apply anymore because the emergency declaration has been lifted. Can you skip to the next slide, please? But there was, Drew, Adrian. Thank you. So the COVID rule, there was an extension that was granted, but it was only granted during a short period of time, so it's no longer applicable. But you can tell your clients that COVID rules did apply for a little bit of time there, where they extended the identification period and the 180-day deadline. Next slide. And covered disaster area. So like when Hurricane Ida came through, they considered that a disaster area. And if you had an exchange that was set up with respect to any properties that was owned in a covered disaster area, once FEMA declares it a disaster area, then you can potentially get an extension on your 45 and 180 days, because you can't close because things are shut down, etc. Next slide. All right, so this is a checklist that I'm going to leave as part of the handouts. You can go through this. It's just like a roadmap to kind of tell you, what you need to do in an exchange, what the periods are, that kind of thing. Keep going. Next slide. That's more of the checklist. And then the next slide. That's questions. Okay, so let me just run through, because you can't see my slides. Let me just run through real quickly what's happening on the horizon. So during the last administration's campaign, they obviously they stated that they wanted to get rid of 1031 exchanges completely. Well, they backpedaled on that, and they decided that, you know what, it's too powerful of a tool, or too powerful of a vehicle. I mean, I can tell you right now that there's something like, I don't know, 3 or 32 billion or $300 billion worth of commercial real estate that's used as 1031 exchanges every year. So now what they've recommended as part of this $3.5 trillion infrastructure bill was that they were going to cap the capital gain exchanges to $500,000 per taxpayer, or $1 million per couple. That doesn't seem, I mean, it may seem like it's a lot, but it really isn't in some of the exchanges that we've seen. The start time for this would be January 1. However, they've been talking about a clawback, which means that if you've done an exchange and you didn't close before April 15th of 2021, you may now be subject to capital gains. They're still working out the kinks. Not really sure that's gonna happen. I can tell you right now that there's a big pack. There's a big advocacy group for the commercial real estate industry, including the National Association of Realtors, that is making a big push to make sure that there are no changes to the 1031 exchange. And let me tell you why. Because what 1031 exchanges does, first of all, it's not a loophole. Right? It's a longstanding, over 100 years old, vetted feature of the tax code that defers exchange, that defers taxes. More than 80% of deferrals are one-time events. Okay, so it's not something that people automatically defer, over and over and over again, although you can in some situations. It helps small businesses build wealth. So when you sell a property for $250,000 and you buy a building for $500,000, you're obviously building a larger asset that's worth a lot more. You can do a lot more with it, et cetera. It restricts job growth. They said somewhere, I think Ernst & Young came out and said that every year, 1031 exchanges, like the example that I gave you with the Kmart and the Costco that came in, well, that created jobs. Ernst & Young came out with an analysis and said that every year 1031 exchanges create another $600,000 or 600,000 jobs in the economy. housing, multifamily housing transactions represent 40% of the 1031 exchanges. So now you can build more affordable housing for people. It raises up these communities, that kind of thing. Creates financial security. The jobs that it creates affects every industry. So real estate agents, obviously with commissions, title and property insurers like us, title companies, escrow agents, lenders, appraisers, surveyors, attorneys, inspectors, contractors, building supply vendors. It goes on and on. So these are all upstream and downstream businesses that are affected by 1031 exchanges. So they say that, you know, if they got rid of the 1031 exchange, yeah, it would probably create about another $2 billion in taxes that would be collected. But because of that, they're not considering the increase in assessed values with the new properties that are being bought, the increase in the SALT taxes, the state and local taxes. So we're anticipating that it could be another $8 billion that are actually generated in taxes because of the 1031 exchanges. So you've got an offset between 2 billion or 8 billion. So, you know, you can see that that the industry has definitely got a good understanding of why they're promoting 1031 exchanges and trying their best not to have them be excluded from the tax code. And I received a letter from my senator who said that they understand it. I had pitched, you know, them to keep the 1031 tax code. What they want to do is they don't want to close the 1031 exchange completely. But what they want to do is they want to close the loophole because if you exchange and then you go and it gets transferred to your estate, you get a stepped up in basis. What they want to do is they want to close that loophole for the stepped up in basis so they can still collect the taxes. Anyway, so with that,
NAR has a link. I think I've sent it out to the Commercial Alliance, but there's a link on NAR's website for sort of 1031 success stories, where if any of you have a client or you yourself have used the 1031 exchange and it's been, you know, beneficial, go share your story. And it's part of the PAC's, you know, initiative to save this. So.
great. So
Shawn, I was just going to say thanks so much for your time. I know I speak for all of our members when we say you've provided invaluable information. Shawn's contact information is going to be sent out. We, you know, encourage everyone to give him a call. Don't, you know, act as the attorney. Use an attorney. Send your clients to him. So we will send out the slides. He's going to send us his slides, which Shawn, I think we have. We'll be sending them out along with his contact information.
sounds great. Thank you all very much. I appreciate it. I appreciate the opportunity, and best of luck to everyone.
Thank you so much, Shawn. And we're getting a lot of thank yous. So thanks a lot. Everyone appreciates it. Have a great day.
Thank you, Shawn. The next webinar is scheduled for October 7th, where you'll hear from the newly installed Maryland Realtors president, Craig Wolf. So he'll be the new president at that point. So come hear from him. So thank you again for joining us and have a great rest of your day.
Thank you. Thanks, Shawn.